So maybe we start our webinar for this afternoon. Welcome everyone to our webinar today, where we will be discussing the approach to intragroup loans in Malaysia. I have to say that this is one of my favorite topics in transfer pricing, and I don't know what it is about intragroup loans that I enjoy so much. I know Kevin also enjoys the joy for intragroup loans. So everyone feel free to ask any questions in the Q&A box. So we can help at the end of the session. We will try to answer as much as we can, depending on time. So before we get started, let us just do a brief introduction for those who may be unfamiliar with our firm, which we will just spend 1 or 2 minutes on this. So essentially, our firm specializes in providing transfer pricing advice to multinational companies. We pride ourselves from being practical, proactive, and cost-effective. We really love helping our clients, solving their complex transfer pricing issues. Before we get started, just a brief overview about our firm. We are 3 offices. Our head office located in Australia, and our 2 offices in Asia, which is Transfer Pricing Solutions Asia, based in Singapore, and Transfer Pricing Solutions Malaysia, based in Malaysia. Both offices are in charge of looking after our Asia and Malaysia and Singapore clients. We have been in business for more than 15 years, and we really love what we do. So apart from that, we are also regular contributors to key industry journals, such as the ISCA Journal, and we have also been nominated as a Tier 2 transfer pricing firm in Asia, Singapore, and Malaysia. And also we have been very proudly earned a couple of awards over the past 5 years, such as Best Transfer Pricing Firm in Australia, Best Newcomer in Asia, Asia Transfer Pricing Leader of the Year by our founder, Shannon. So a couple of introductions on our panelists for today. So first of all, Hon Chuan Tan, who is the director and technical leader in Malaysia that has over 10 years of experience in transfer pricing. He is well known for being a pioneer in developing transfer pricing practices in Malaysia, starting with one of the mid-tier firms before joining us in transfer pricing solutions. So we're very lucky to have him. He loves also assisting clients with complex transfer pricing issues. We also have in our panel for today, Kevin Tai, who is our senior manager in Asia with more than 9 years of experience advising multinational companies in Australia, Malaysia, Asia, and the US. And he is also another passionate technical lead who loves resolving transfer pricing issues for his clients. And myself, for some of you who don't know me, I will be the moderator for today. I'm the director and co-founder of Transfer Pricing Solutions Asia and Malaysia with more than 15 years of experience in advising multinational companies in transfer pricing and tax across 4 different countries. And I have in common with Kevin and Hon Chuan that I love transfer pricing, and I love also tax, so believe it or not. So with that, let us go to the agenda for today. So we will be talking about first, giving an overview of intragroup loans in the context of transfer pricing. Why do multinational groups enter into intragroup loans, and how is the general way in which it can be approached from a transfer pricing point of view? Then we will be talking about Malaysian transfer pricing guidance and how can you manage your transfer pricing risk in Malaysia when entering into intragroup loans. But before that, let us just release a poll question where we want to gather the level of understanding in the audience in order to know how we can essentially make sure that we can clarify some misconceptions, or how I call it, bust some myths about intragroup loans. So let me just launch the poll, which essentially is which of the key elements below you look at when pricing intragroup loans. Option number 1, contract contents. Option number 2, TP documentation. 3, benchmarking analysis. 4, substance of the transaction. And 5, none of the above. So let me just launch the poll. It will be great if people can participate. We will give a couple of minutes, and then we can share the results with everyone. The stats are moving in different directions, I have to say. I don't know if you, are you guys able to see the real time? Okay.
Nope.
I'm seeing the real time, and it just goes in a lot of different directions, which is quite amusing. We have 79%, 80, 81, and I might just leave 10 more seconds, and then we can end the poll. All right. So the results are quite split, I have to say. Can you see now the results? So essentially we have that 20% believe that is the contract content, 20% TP documentation, 28% benchmarking analysis, and 33% substance of the transaction. I'm happy to see that no one says none. But interestingly enough, a lot of people have answered substance of the transaction, which actually is something that we're gonna talk about today together with the contract contents, because I think it's important to understand that the success to managing the risk associated with intragroup loans comes from having a proper foundation. So let me just close. Are you guys back into the slides?
Yep.
Okay, excellent. So with that, I would like to invite Hong Chuan to give us a bit of an overview of what are intragroup loans and why do we have to look at them from a transfer pricing perspective.
Thanks, Adriana. Hi, guys. Intragroup loans. Intragroup loans, I guess in Malaysia, is actually one of the key areas that has been increasingly scrutinized by the IRB as of late, as compared to last time. And actually, it's very important now, especially now, to actually reassess your risks in relation to intragroup loans, not just the TP risk, also tax risk as well. Now, I guess first thing we need to look at is why do we have intragroup loans in place, and what's the incentive that has been provided for the group itself. First would be the optimizing of the external cost of borrowing, right? There are various ways of structuring and kind of intercompany financing, and the entity, generally with the entity with a higher credit rating, generally the parent entity, would be able to borrow from banks at a lower interest rate as compared to its subsidiaries. Instead of having the subsidiaries to go to the bank, negotiate with the bank for the best interest rates, the subsidiaries could actually then borrow from the parent entity and enjoy a better interest rate, and then thereby saving costs as well from your administration burden and the process of obtaining the loan themselves, right? Which relates to my next point, anyway, of reducing the external costs of funding. When you actually centralize your financing within your group, you can potentially reduce the overall external costs of funds within the group, as based on costs I mentioned earlier. And thirdly, when the group has proper governance on your group's financing, and you have a clear view on your group's cash flow, right? Intergroup loans then can be used to optimize the cash within the group when there are excess cash within an entity, which could then be better spent in another entity. So this is generally what we call a cash pooling exercise, so that the group could efficiently utilize these excess cash and making sure that it can be used efficiently as well, right? Lastly, it's also a good tool to actually provide a more flexible investment arrangement so that the group or the entity could achieve a good mixture of both equity and debt, right? Your debt and equity ratio. And this is something that maybe in Malaysia was not that important, but then with the introduction of the earnings stripping rules in place back in 2019, this has become even more important to ensure that you can actually use intercompany loans to actually optimize your interest deduction, right? Which we'll briefly go through later.
Excellent. So, Honchun, do you want to go through essentially why is it that there is such a focus on intercompany loans lately from a tax authority point of view?
Yeah, I think if you look at the benefits that it provides, obviously then it'll be deemed as a higher risk as well, right? It's more of a high risk transaction and has been looked at globally as well by tax authorities because it can be easily formalized through a contract, right? And then manipulated through the contract, which can result in either excessive interest expenses deduction in a higher tax jurisdiction. And then on the other hand, you have excessive interest income in a lower tax jurisdiction, right? This is where tax authorities are trying to avoid, make sure that you do your own due diligence. And now that we're talking in Malaysia, I'm sure you guys are aware that your company or your clients may have interest-free loans going back and forth, which is very common. I think more or less almost all 80% of the intercompany loans I've seen, if you look at the audit accounts, it'll be interest-free, no repayment terms. But then gone are the days where these interest-free loans go unnoticed, right? With the current situation, the RB is actually well equipped with intra-group financing knowledge to be able to actually scrutinize these arrangements, so that now is actually a very good time for you to reassess your intragroup loans, which leads to my third point, where first you need to identify your interest-bearing loans, and where possible also perform a debt and equity assessment to see whether there should be any reclassification to your instrument. And lastly, even though intragroup loans, you think intragroup relates to TP, but actually it doesn't relate to TP alone, right? There are also other general tax rules involved that need to be looked at together, as there are some key issues that need to be resolved at the delineation phase, right, before proceeding to TP, where you first need to consider the earnings stripping rules as well as other general tax rules that are put in place in relation to loans.
Excellent. Hunchan, so if now I'm going to ask you to wear your crystal, or not crystal, wear your technical hat, and tell us a bit, if you were working in a multinational or in a company and you had to set up a loan, what would you be looking at? What would be the key things that you would be looking at?
Yeah, I will briefly go through how to actually how to properly set up a loan transaction. There are several key elements in place, right? The initial step, of course, to ensure that a contract is formalized by performing a TP analysis on the intercompany financing arrangement, right? The process involves performing a debt equity analysis first to make sure that it's in substance a debt instrument, right? After which, then a benchmarking analysis needs to be performed to determine the arm's length interest rate to be charged. Then once you have all these key elements in place, it can be properly documented into the contract. If you look at the process, if you go through this process will not be concerned with the term that you have always heard, substance over form issue, right? As well. And so if you look at this cycle, the thing that I would like to emphasize from a TP standpoint, the two main things are, first, make sure the substance are in place. And secondly, obviously, the arm's length interest rate to be imposed.
Thank you. Thank you. That has been a very good summary, HC. Good insights here. So maybe now now that we have kind of the foundation and some key consideration, we can go into the detail of the Malaysian approach and how, and that I'm going to call Kevin to tell us, okay, Kevin, if you were a TP manager in a company in Malaysia, how would you approach and what would be the key things that you would have to consider?
Yep, thanks, Arina. So transfer pricing, intercompany loan has been a very hot topic in transfer pricing, since the creation of transfer pricing. But unfortunately, in terms of referencing, especially if I'm not, in touch on intercompany loan dealings with the tax office on a day-to-day basis, as a tax manager in a corporate, how do I know what to look for? What we can actually have a look at is actually just, for at least for Malaysia, it's just Malaysian transfer pricing guidelines, which is more or less aligned with OECD guidelines. But just unfortunately for us, we do not have any big public information on, any litigation related to transfer pricing dispute in this field, at least in Malaysia, that we can refer to and take notes of. But there is actually one case that is quite a significant case within our region, which is called the Chevron case. Now, this case talks a very detailed technical discussion in what an OECD transfer pricing analysis should look like, and what are the key principle, theory, and concept that you need to be looking at when you are doing the analysis. Now, this is very good because it gives you from a practical perspective on how your theory should be applied. Okay. Now, this case is such a landmark case. It actually influenced the recent OECD guidelines on financial instruments. And, OECD being the Bible of the transfer pricing guidelines, has been adopted by many countries, including our neighboring countries, Singapore. So we would expect IRB to sort of use this case as a reference and use the new OECD guideline as a reference in working out or in setting out their approach in intercompany loan very soon in the future. So let's have a look at what are the facts or background of the Chevron case. Just to give you a bit of understanding and background, this is Chevron Corporation. It's a giant oil and gas company, a global company. Now they have two companies here in this picture. One of that is in Australia, which is an operating company in Australia called the Chevron Australian Holding. Another one is a funding vehicle that is set up called the Chevron Taxable Funding Corporation, or in short, we just call it CFC for now. What they actually did was get CFC to go into the US market, issue some commercial papers, and raise about $2.5 billion worth of funds at a 1 to 2% interest rate cost. So to be specific, it's about 1.2% interest rate. And they channeled the entire of this fund to the Australian entity, and they charged them an AUD LIBOR plus 4.14%, which works out to be at the time 9%, around 9% interest rate. Now, just from this arrangement, you can see there is potentially an TP issue here, because first of all, you can notice that the loan they are taking, or the fund they are raising from commercial papers, is a very low cost fund. It's 1.2% at the time, and they are charging it at 9% to Australia. And further, when they go into this case, they found out that whatever interest income they receive in CFC is not taxable. So what they actually did was they claim a tax deduction in Australia at a 9% interest rate. The income goes to CFC, which does not pay tax, and then they channel back the income back to Australia as dividend payment. And that dividend is also not taxed in Australia because it's a foreign dividend. Now, that is why the tax office said that, no, we need to bring this to the court and settle it once and for all. Obviously, there are a lot of technical discussion they go through. This case spanned across around 2 years before they wrap up everything and reach a settlement. But we have highlighted here, I think, 5 of the key challenges that we can rely on, or we can make reference to when we are doing our transfer pricing analysis, at least in Malaysia, to make sure that, you know, we have at least look at, you know, the important parts of, you know, how do you apply the theory. If you go into the next, yes, Adriana?
Yeah, give me 2 seconds. It's just my computer is gaming. Okay.
Right.
There you go.
Okay, so let's go into now all these points, all these key points and challenges that were brought up during this case. Now, there are 5 key ones actually, which we will go through in more details in the following slide. The first one will be the substance of the loan. Anyone can tell you substance is the first thing of transfer pricing analysis. Substance is everything. Without substance, your analysis got no foundation. Okay, and then second one, the value of the loan. Now, value in these terms is to look at, you know, whether or not it's commercial to the borrower, whether or not they have the capacity to borrow such loan. And then obviously the next one, you have the pricing of the loan. You know, as always, that is the core transfer pricing analysis that you need to go through when you're setting up the price for intercompany loan. And then the next one, you have credit rating of the borrower. Now, this credit rating, I would say sometimes you can even group it as the pricing of the loan part of the process, because that fits into your analysis. But because the Chevron case have stress on this point, this particular point, and this is such a essential argument in the case that sort of tear down Chevron's analysis in the past. So we just put it as a separate, and we will talk about it later on in this presentation. And then lastly, obviously, the core principle of transfer pricing, the arm's length principle, would an independent party have entered into the transactions? Okay, so now let's look at the first challenge, substance. The interesting thing with intercompany loan is it is not easy to identify the substance, in the way that, for example, if you compare to a service or you compare to a stock purchase, product purchase arrangement, you can see the actual transactions going on. You can see the service being provided. You can see the goods being acquired and in what fashion. But intercompany loan, what you can really see is just your intercompany accounts. So how do you determine what is the substance, right? First point of the starting point would usually be your intercompany contracts. That's why we always say that if you put an intercompany loan in place, it's very good. It's very important that you also put in an intercompany contract just to document what is the nature of this loan and what are the terms and conditions that applies to the loan. So when we look at the loans, we look out for a few key terms. First of all, whether or not there's a fixed repayment date. A commercial loan usually will have a date that where the borrower have to repay everything. Is there a purpose to this loan? Do you take out the loan for, you know, a commercial factors, or you just take out simply because you want to channel interest away, income away to another country, right? Is there any security that's put under for the loan, or any financial covenants that you have agreed to as part of taking out the loan? Does the loan provide gives rights to the lender to enforce the payment of principal and interest? obviously, is there any obligation to pay interest at all by the borrower? And then if the borrower does not pay or repay the principal or the loan for the loan, will there be repercussion that was included in the intercompany agreement? Now, all this is quite straightforward in theory, but in practice, you might not understand how does the difference of all these terms and conditions if impact on my substance of my loan, right? So we've come up with an example in the next slides, just to give you sort of like an understanding on how this impact substance of the loan. Now this is an extreme case. Just a heads up, you might be in this situation. You might not be in this situation, but just bear with us. You have company A, which is, for this example, a leading manufacturing company. They provide funds to a finance entity through a combination of debt and equity injection. And this finance company then use these funds and channel it down to a related party company B as intercompany loan. Now this loan is about 100 million with an 8% interest rate. Now to work out the substance to see whether or not this is in fact a commercial loan, we found out that the term says this, right? You have a tenor of 100 years, so you have 100 years before you need to repay this loan. There's no repayment clause for the principal, and the borrower, which is company B, is not required to pay any of the interest or principal unless it makes a profit. So looking at these terms, and if you compare it with a third party, would they be willing to accept this kind of loan arrangement? Obviously the borrower will be happy to, but the lender will lend out such the loan at this condition. So in substance, it is not commercial, and it doesn't reflect a debt characteristic. It's more like an equity injection.
And I think, Kevin, with this extreme example, the easiness or the concern from tax authority a lot of the times is that this type of arrangement with these unrealistic commercial clauses start looking, I call it, start smelling like equity, because essentially is a contract that I do not have any tools or any avenues to enforce repayment of neither the principal nor the interest. And that is something that in a third-party situation wouldn't happen. I call it that the equivalent is like we going to a bank and saying, can you lend me 100 million and I pay you whenever I feel like it, yes. With no interest. For those of you who have mortgages will know that that is an impossible in the real world, right? So that's where I think that's the concern, that if that doesn't happen in real life, then it starts smelling a lot like equity, right? Thank you, Kevin. So maybe let's talk about value.
Yep. So on value, yep. Sorry. So on value, that point is pretty much straightforward. You look at whether or not commercially you can afford the loan, whether or not you have the capacity to service the loan, the interest expense. One area to look at it is probably the best, or the best place to look at it is your financial performance, your P&L. Whether or not you have the capacity to do that. Another alternative will be, now this is a bit of a far-fetched one, which is the credit rating. The theory is the better your credit rating, the more likely you will be able to service a particular loan. That is how the credit rating sort of computed by the rating agency. And obviously the last thing is, is there any limit on the interest deduction? Now this leads back to in Malaysia, the earnings stripping provision that HC has mentioned earlier. We are not saying that just because you breach the earnings stripping provision, your loan is not commercial. We're just saying that this is probably not very tax efficient for you to do that, because it doesn't matter whether or not your pricing for the loan is correct and your substance is there. What is the unless there's a very specific that you need the funding, you will not be entitled to claim 100% of the interest deduction for your tax return. Okay.
So then let's talk about our famous pricing and avenues to price.
Yep, now this is the interesting one. Pricing of the loan in terms of transfer pricing analysis, they usually have skewed towards a CUP analysis in the past. And more recently, it goes a lot to the cost of funds, and mainly because of the Chevron case. Now, I'll just give you a bit of a background or overview what is two analysis involved. Now, the CUP analysis, many of you may be aware or may be familiar with. First of all, you work out your substance of the loan. Do you have substance? You evaluate the terms and conditions of the loan. You then go into the analysis. You prepare. You perform a benchmarking analysis. And then obviously when you prepare benchmarking analysis, you need to work out the credit rating of the borrower. Now, if you remember earlier, I've mentioned the credit rating is one of the key challenges in the Chevron case. And what leads to that is basically, in the case, the tax office actually argued that you are not supposed, well, you can't just look at the credit rating of the borrower in isolation. This is now, bear in mind, this is the most widely accepted approach before this case. Everyone, I would say, is doing something similar. We are just looking at, let's say, for example, this is the Austrian company's credit rating on a standalone basis, because we want to know what it costs for this type of company to go out to the market to get fundings. But what the tax office argue is, you are part of a global corporation with very strong financial backing. It is not realistic for you for us to look at you on isolation, because on a standalone basis, maybe your operation in Australia is small, you do not have the financial backing, therefore your cost of fund is high. But because you are part of this group, and and obviously there are a lot of technical discussion that went into it. One of that is they look at the group funding policy. It happens that they found evidence that the group will always provide parental guarantee to their subsidiaries when they go out, and their policy is to always minimize cost of fund. So based on that, it is not reasonable to just look at you in isolation, or they call it the orphanage approach. Because if you're getting a parental guarantee, then you have the full financial backing of the group. And then your credit rating should be the credit rating of the group instead of the borrower. So these are some of the small technical things that we get out from the case that will significantly impact how you price your transactions in the future. Now back to the CUP analysis, you work out the credit rating depending on your group policy and the credit rating, whether or not you use the group or you use the standalone borrower. And then you do your benchmarking analysis, you make your comparability analysis adjustments to match the terms and conditions, and then you get your price. That is the CUP method. Then you have your cost of fund method.
Should I go back?
Oh, yeah,
Okay,
sure.
okay. So you have your cost of fund? Yeah.
Yep. So cost of fund method is quite straightforward and it's quite simple. On paper, it's quite simple, but there's also a lot of analysis that goes behind it. On a layman term, what it actually does is they look at your group and your company, whether or not you have external funding, external bank loans, and then they look at the interest rate charged on the external bank loan and compare it with your related party loan. Are they similar priced? In another way, you can call it similar to an internal CUP. Okay, so that is the cost of fund. So now we move into what is an external CUP, which is the traditional go-to method for the intercompany loan. Like I mentioned earlier, just a very quick recap. You work out the credit rating of the borrower. You depend on not you use the borrower or the group. Depends on the policy as well. And then you work on your benchmarking analysis to come up with the interest rate. The third one is a more, I would say, a newly added steps where we demonstrate the intercompany is supported by commercial and financial reason. In the past analysis, we have always been saying that this is the loan, that is the price, and that's it. we conclude at that. Now we pay more attention to, is it commercial? Does it make commercial sense for the borrower to go into this loan at this price, or would they not go into it at all? So that is something that we need to consider. And then TP analysis, when do you need to do it? Like all intercompany transaction, especially the new one, you should do a TP analysis before you put in the intercompany loan, because then you can be sure that your pricing or your interest rate charge is supported by a thorough analysis. Okay, so that's the external CAP. Now, we've gone through these two methods, but how does it play out in practice? Again, we will look into an example, and then you will I hope this gives you a bit of more understanding of what I meant earlier. So,
Kevin, 2 seconds. Yep. There is a question here about what does CAP stands for. So CAP stands for comparable uncontrolled price, which is one of the methods in transfer pricing to test transactions, and particularly the main or the most accepted method when it comes to loans when not going down the path of cost of funds. So please go ahead.
Yep. Yeah, that's right. Sorry, I didn't see the question earlier. So yes, okay. Control and comparable uncontrolled price. If you break down the word, it's basically meaning third-party price on a comparable situation. For as a layman term, less technical term. If you look at this example again, let's say we have at a head office, which is a manufacturing distributing company. They provide some funds through intercompany loans to the subsidiary in Malaysia, and the terms includes, this loans is 5 years, it's 50 million USD worth. The rate is LIBOR plus 1.5. Now this is very vanilla loan, nothing special that comes out of it. You want to price this loan, or you want to know whether or not the LIBOR 1.5% is consistent with the arm's length principle. Again, previously we talked about two methods. Let's go with the easier one first, which is the cost of funds. Now, you look at that, look at the structure, that is a third-party bank loan that goes into the head office. Now, because you have a third-party loan, you can compare this third-party loan to company B, work out whether or not they are similar, in terms when they are entered into, and compare the interest rate. Then, obviously, there are, potential adjustment that you need to do. But on the, conceptually, that's what you need to do, compare your third-party loan with your related party loan, and whether or not they are consistent. Okay, that is the cost of that. External CAP, you start with the head office perspective, look at the policy, whether or not, it usually provide guarantees, or they have a policy to provide guarantees to the company B. Then you decide whether or not, the credit rating should be used for company B or the head office. From there, you do your benchmarking analysis, you do your comparability adjustment, and you come up with your sort of arm's length interest rate that you can charge on this loan. And then you compare it with the rate you apply, then you will know whether or not you support your interest rate for your intercompany loan.
I think I want to ask two questions here that usually happen. Is like, we're talking about company B. So the question is, can company B use bank quotes to price this loan, meaning the Malaysian entity?
Now, bank quotes.
Happy for HC also to chip in if he wants to.
Yes, of course. Sorry, HC, if you have anything.
Yeah. So I guess this is a gray area, right? Especially in Malaysia. In other jurisdictions, a quote, especially they are following OECD, quotation is not relied on anymore. I think previously, based on our practice, financial quotations are actually relied on and used as a basis. But based on the recent development on your intercompany financial transaction guidelines by OECD, a quotation is generally not can't be used as a basis. But there's no such rulings or guidelines, because the guidelines for Malaysia in relation to intercompany transactions, loan transactions, are rather vague and it's like a 2-pager type of guidelines, which is not good, because they should actually provide more detail as to how best the taxpayer could reassess the intragroup loans, right? What kind of basis they can use, right? For now, they are saying that, oh, the best method is comparable uncontrolled price. But in Malaysia, if we can still use the quotation as a supplementary, but not as a main basis of pricing, so to speak. Do you have?
Yeah, that's,
Yeah, I sorry. Yep,
yeah, you go. You know, you go.
Yeah. So I think I completely agree, because like you said, quotation is just a quotation. It does provide you a reference point of what your cost would look like if you were to go out to market to raise funds. But like I say, it's not executed. It's not final. It can change depending on circumstances. There's always a caveat to using quotation. In those situations, what we usually do is you do your main analysis first, your external cap, if there's no internal reference to your cost of debt, your external cap approach. Maybe you will put a more conservative approach to include the quote as a supplementary to show that, look, external cap is saying this range. My quote is also reflecting something similar, so I'm really well covered.
I think another point that I heard once from one of the tax authorities was that essentially the reason why they also don't are not very or not very in favor of accepting quotes is because quotes is because, first of all, if the client has a good relationship with the bank, they can also manipulate what the bank says in an email. That's one thing. And then the second thing is that if the monies don't go or don't get disbursed, and if there is not a formal agreement, some tax authorities may view that this is then not, if the quote don't materialize, then there is not really risk. So in other words, the quote doesn't involve an actual transaction where the bank has actually taken the risk. So those are the two arguments as well that I have heard, just to share with you on some of the tax authorities as what is their concern on the quotes in general. So anyway, I think with that, we can move on into the earning stripping rules, HC. So it will be great if you can just give us a brief overview on earning stripping rules.
I know that there are a lot of questions coming in, so I'll just quickly go through the earning stripping rules and answer all your questions later. So, okay, earning stripping rules is actually one of the big changes in Malaysia. Previously, there's no rules or provisions in place to actually limit your interest, so you can actually deduct the maximum amount of interest expense. But then, effective 1st July 2019, the earning stripping rules was introduced, and RRB released a guideline on the precision on deductibility of interest, and the guidelines is actually adopted predominantly from the OECD BEPS, the Base Erosion and Profit Shifting Initiative Action 4. You go and Google it, and on the limitation on interest deduction. The aim is to actually, obviously, in favor of IRBs, limit the interest deduction through the use of interest expense to achieve excessive interest deduction or to finance the production of exempt or deferred income, right? So at the moment, the ESR only applies to foreign intercompany loans and does not apply to domestic intercompany loans. As we know from Malaysia, this may change in the future, and they might add in another provision and say that it includes domestic as well. But it would be great that you have this at the back of your mind, even though you have domestic intragroup loans in place. And then another important point is that it also applies to third-party loans when a guarantee is provided by your holding company or a related party when the financial assistance is actually obtained from that third-party financial institution outside of Malaysia, right? The key thing is the third party has to be outside of Malaysia, and then regardless of the tax residence of the guarantor. So the holding company can be inside Malaysia and the ASR will still apply if your third-party financial institution is actually outside of Malaysia.
Excellent. So could you just talk us through some of the key features and basically what are the key highlights and features?
Okay, so for the ASR, the maximum amount of interest deduction is 20% of your total amount of tax EBITDA. So here, earnings before interest, but partially interest, not fully, partially interest, tax, depreciation, and amortization. I'll go through the calculation in the later slide. So as you can see, the foreign interest expense deduction is actually very much dependent on your earnings, which is a huge change from the previous landscape, especially when you have a negative tax EBITDA. So if you have a negative tax EBITDA, which means your deduction is actually nil, which means you are actually denied on the tax, interest expense deduction. So, but the guidelines also provide a de minimis threshold for interest expense of not more than 500,000 ringgit. And bear in mind that it includes all financial assistance from all business sources. And lastly, any excess interest expense can be carried forward to the next income year, but subject to the maximum allowable interest deduction for the next income year. So that still needs to be calculated and then add on to the excess interest expense accordingly.
Excellent. Thank you, HC. So maybe we can go ahead with a small example.
Yeah, I just illustrate this to assess whether, under what circumstances actually you fall under the ESR, right? So if you look at this example, we have a holding company providing loans to its subsidiary, and the subsidiary also obtain loans from a third-party bank with a guarantee provided by the holding company. Now, the key aspects for ESR to apply is to look at the location of the holding company and the third-party banks. If for the first scenario, if the holding company is actually located outside of Malaysia, then this arrangement will apply, barring, of course, the de minimis threshold. And then for next scenario, which is the guarantee provided by the holding company when the financial assistance is obtained from a third-party financial institution. So here, the key point is the third-party financial institution will need to be outside of Malaysia for it to apply. And regardless of whether the holding company is in Malaysia or not, even if it's in Malaysia, the ESR will still apply, right? So now that you have gone through this illustration, hopefully you have a general idea on the application of ESR, and it's important for you to actually go back and reassess your intercompany loan arrangement to make sure that ESR does not apply.
Maybe if you can see, give us a quick overview on the calculation.
Yeah, a brief calculation of the tax EBITDA. So it involves adjusted income, right? This adjusted income is actually before any interest restriction on the deductibility of the interest from the company's business source. But if you require further illustration, actually the guideline in Annex A, they actually provided a whole list of calculations for you to look at and to see what line items are actually involved in calculation of the adjusted income. Then the next element is the qualifying deductions, where it's a total amount of qualifying deductions allowed before the restriction of the deductibility of the interest. And then lastly, for the interest expense part, this is actually the amount of interest expense subject to restriction of the deductibility of interest. Not all interest expenses, just the interest expense which are subject to restriction on the deductibility. Right. Then lastly, as I mentioned earlier, negative tax EBITDA will be considered as nil for the calculation under the guidelines. So which means that if you have negative tax EBITDA, you have zero tax deductibility.
All right. So maybe before we go into just a quick 3 key takeaways, and then we can go to questions. So who wants to start with takeaway number 1?
Yeah, I think I can go with that. So the takeaway number 1 is, obviously understanding the TP and tax risks for intercompany loans. Ideally, in the ideal world, we want to have, a comprehensive analysis for every single loan that we have or every single transfer pricing transactions that we have, but it's not always practical. In the case that the value is not that much of a risk, you still need to do analysis, but you can have a more simplified approach. That's probably my key takeaway.
Right.
Yeah.
Well, my key takeaway from Kevin's session is to always check for internal cups and of course the group cost of fund, which is very important for intercompany loan transaction and has now become the general approach to support your intercompany loan transaction. And funny thing is, because in Malaysia, companies in Malaysia generally are not well aware of intragroup loans, and we can't just simply charge them with the credit rating and the benchmarking analysis. So back in Malaysia, because of the fee restriction and constraint, we generally actually fall back to using the cost of funds and also internal cups, because that's where it's more cost efficient and less costly to actually prepare to substantiate the pricing of the loan itself.
And I think my takeaway from your part, Hong Chuan, is the limitation in interest deduction and the earnings stripping rules is definitely something to consider if you want to fully utilize the interest expense deduction in Malaysia. Having said that, I am not entirely sure that I understand the rationale of the earnings stripping rules, because I think I share with you that if my EBITDA is negative, that's where I need funding probably, especially if I'm in a startup situation. So I'm not entirely sure whether I agree this is the best way to limit the interest expenses, but nevertheless, that's what we have. So with that, we can open for questions, because I can see there is quite a lot of questions over here. So let us start with, okay, there is like 8 questions. We'll do our best to answer. So let's see the first one. So is it compulsory, answer that. Is it compulsory for holding company, the lender, to charge corporate guarantee to its subsidiaries, the borrower, to fulfill the arm's length principle or for TP purposes? And what is the basis for that corporate guarantee? So I think we didn't talk about corporate guarantees in general, but there is a very famous case that was the GE case on corporate guarantees. And I think nowadays what the general approach is that the corporate guarantee cannot be implicit. So it's not something that you can charge as a service just because you're part of the group. That is understood as an implicit corporate guarantee, and generally actually would be understood as non-chargeable. On the contrary, the corporate guarantee can be considered a service if it is explicit. So there has to be an explicit contract being given, then it can be chargeable, then it can be deductible. So that's the general approach for those, because I can see a lot of questions about corporate guarantees. So I don't know if you guys have, there is different methodologies to price, and I think we are not going to go into that detail, but the important thing is the starting point is it has to be explicit to be chargeable. I don't know if
that's a good point, right? Like whether or not you charge guarantee to your subsidiary to meet the arm's length principle. Now, one of the discussion raised was on this matter was, yes, if you are guaranteeing for some a third party on behalf of your subsidiary, then yes, definitely there's a guarantee that you provide to your subsidiary, but it was provided to an external party. For example, you are going to get a bank loan, your parent entity provide you with a guarantee, then they will charge you a guarantee fee. That is normal. But the issue arises is when you have intercompany loan in place, do you charge guarantee from the head office to your subsidiaries? Now, this is a bit of a funny one, because how can you guarantee yourself that you will get back your funds that you loan out to your subsidiary, right? That is one of the argument that is that how can I then charge my subsidiary that I'm giving loan to a guarantee fee? So I'm in fact essentially guaranteeing myself that I will pay myself if my subsidiary fail to pay me.
Yeah.
So that is the concept. That's like that's why it leads towards, yeah, in terms of intercompany loan, we don't, there's not enough substance or reasons to charge a guarantee fee.
That's a really good point.
Mhm.
There is another question here. How to determine the arm's length interest in Malaysia if the amount is immaterial, only few millions, credit rating is expensive, and CUP method not practical?
Only few million of balances, or only few million of interest expense. So I'll imagine it's balanced. But yeah, I guess it really depends on your company's budget, right? I mean, we generally look at the risks involved, right? Obviously, it depends depending on what you deem as immaterial versus what we deem as immaterial. And of course, if you look at interest free, then obviously you have risks there. And if it's really immaterial, then generally speaking, if you actually allow, if the amount is not that huge, I imagine then it would not be of significance, and it would not really significantly impact on the tax perspective, right? And yeah, so it depends on your risk, the management risk appetite as well on
Yeah.
that matter.
Yeah, I agree with you in the sense that in theory, you have to just do an analysis. How you go about it, that depends on the facts and circumstances of the agreement, but you can decide obviously to do nothing. And that's basically a decision that the company can make, but is based on the risk appetite. I agree. I think that's a fair point. There is another one that I like a lot here. That is this example, in this example, which is the one that we did before, what if the loan interest granted by from head office to company B, meaning the Malaysian company, is lower than the interest rate from third party? That's the typical situation that we face a lot from a Singaporean regional head office point of view. And I think that can have different angles. But I guess generally, if it's lower, the risk will probably be more from Singapore point of view rather than from Malaysia point of view. And then you will need to understand why would the Singaporean entity will have to bear part of the cost of funds at Singapore level, because that's what essentially will happen. So that question, I like it. But I guess my answer here is essentially that you have to understand the reason for the head office absorbing part of the interest expense. I don't know if you guys have another question on this.
I think but yeah, as you know, TP is actually both sides, right? You have to look at both ways, just one angle alone, right? If it's favorable to Malaysia, doesn't mean it's favorable to the another tax jurisdiction. Hence, the concept of understanding principle, making sure that both sides are dealt with equally.
Okay, so
Having
let me
our
just, sorry,
tax
yeah.
expert is cut
off. So let me just go with another question. Maybe we can just do 5 minutes more, and then we can do a couple of extra questions. Let me just see what would be.
I'm sorry, I just dropped out.
Sorry, that's okay.
I've got issue with internet.
I guess you just want to
There
answer
is,
the question.
let me just go with a couple of questions here that are about interest-free loans. So one is, what is the basis for an interest-free loan to be acceptable? And another one is, how do you go about comparability analysis for interest-free loans? And I guess what I can sense here is that generally everyone is asking about how to go about interest-free loan and whether it is easy to deal with or not. I don't know if anyone has some preliminary views on this.
On a Malaysian perspective, as I said earlier, there are a lot of interest-free loans in Malaysia. And I'll give, in the PB guidelines, interest-free loans is actually not acceptable, right? You need to have a arm's length interest rate applied. But having said that, first, as we mentioned earlier in the slides, you have to do a debt and equity assessment and make sure that it is actually debt. If it's actually debt, then you need to have an arm's length interest rate. And if it's actually of equity, then it should be deemed as equity and no interest deduction interest should be imposed. And I would also like to point it to you that's as another provision that is in relation to loans to directors, right? I mean, not in terms of intercompany, but loans to directors still deemed as real party in Malaysia. So in that provision, even though you provide interest-free loan to your directors, for example, in your calculation to your income tax return, you still have to be, the loan is deemed to have provided imposed interest on it, and there's a calculation on how you actually impose interest and calculate the interest to the directors, and then declare it into the income tax return, right?
Yeah.
So that's another angle that you can look at it as well.
There is another one, maybe we have time for one more, that was put in the chat, which I find interesting. Even if an intercompany loan agreement has terms which are the same as the third-party loan, intercompanies would rarely take action in the event of default. So do the terms of the agreement even matter? I like this question because it's a controversial one. So does anyone has any views on this?
Yep. I think it does matter. Like, look, if you look at it internally from a management perspective, it doesn't matter because you have absolute control on the subsidiaries' decision as a head office. More in on average, right? I'm talking about the normal corporation. But from a tax perspective, it makes a big difference because, like Heishi just mentioned, tax, you have equity, you have debt. You can claim interest deduction for debt. There's no interest deduction for equity. That is one of the point. It deals with the tax provision. Second thing, it impacts your analysis because when you do a transfer pricing analysis, although we don't look at every single terms and conditions, we look at more of the some of the key terms and conditions, which we will compare it with the third-party agreements that we are looking for. So to ensure that we are giving you coming up with the best reasonable estimate of the arm's length price, we need to have similar terms and conditions. Because to be honest, terms and conditions in the agreement in loan agreements can have material impact on the pricing. So that is why it doesn't matter to the company, but from a tax and transfer pricing point of view, it can have significant impact.
Yeah, I actually agree with you in the sense that it comes down also to governance as well, because what tax authorities will ask you first will be also a contract. So if the contract has uncommercial terms, then that will bring issues also in a review, because all the tax authority has to trust is the contract, basically. So I think your point regarding the tax treatment is even a more of a concern as well. I don't know, HC, if you have any points in here.
Yeah, I think I totally agree, especially when it's during the audit time when it especially matters, because tax authorities will be looking at all those contracts and see whether you have this, you have the criteria in place versus what you have analyzed in your TP documentation, and cross-check all the details. And then that provides an argument for them against you sometimes. So you have some some criteria in place, it may go against you than be favorable to you. So
Yeah,
That's
so
right.
I think
Yeah,
that, yeah, you
sorry.
go. No, you go. you
Yeah, I
go.
mean, yeah, just for example, in the event of an audit, if you have an intercompany agreement that has no repayment date, no a contingency that allows the borrower not to pay interest at will, then and you are claiming interest deduction in Malaysia, in the audit, when they come and review your arrangement, they can argue that, look, your intercompany agreement do not have a characteristic of a debt, therefore we are not giving you deduction for the interest expenses.
So I think we covered as much as we could. There is still quite a few questions, but I think people are starting to log off. So we can always do the intercompany loan second part, given the interest in the topic. Obviously, we will send the video with the slides, and please, happy to also invite you all to follow us on YouTube. We post always very helpful material with our transfer pricing insights. And please stay tuned for our next webinars coming on in October, 21st of October, year-end TP adjustments and TP tips. And 28th of October, we'll be giving a update on the new e-tax guide in Singapore. And thank you, HC and Kevin, for your insights.
Yeah, just a quick note, like, sorry for those that we cannot answer your question. If you have real concern, feel free to reach out to any one of us to have a separate chat. We are happy to do that. Yeah.
Yes. This is our contact email, basically.
Yep.
Here. Thanks, everyone, and speak soon next month. Thank you.
Thanks, everyone.